In December 2021, I had an investment portfolio value of £38,618. 15 months later, and having invested £8,047, today I have an investment portfolio value of £38,973. This is my truth behind investing into the stock market during extremely tough market conditions. From all-time market highs, here is the decline in value of share prices in all of the investments that I've made. Now you might be looking at those numbers thinking what a terrible investment portfolio and an even worse investment strategy. But what if I were to tell you guys that my two investment portfolios were currently showing an unrealized profit, despite all of those numbers being down so bad, and that it wasn't down to any degree of luck, and that it was all intentional and all part of my investment strategy. With my Vanguard UK portfolio being up 73.89% and my Trading 212 portfolio being up 0.37%, the equivalent to a total unrealized profit of £6,027. Well, in today's video I wanted to share with you guys exactly how I pulled this off with a 3-step plan, and within that plan I'll also share with you guys the huge potential profits that I'm due to make in the future too. But before we do all that, guys, be sure to smash a like on the video for the YouTube algorithm, and be sure to let me know down in the comment section as well what your investment portfolios currently look like. With that being said, let's begin. Step number 1. Profit is the plan. Profiting in the stock market is a very simple concept. It's the difference between your cost basis plus or minus a little bit of exchange rate difference and the current price of the stock. For example, with Tesla's stock, my current cost basis is $177.95 and Tesla's current stock price is $194.75. So my unrealized profit per share right now is $16.80. If you multiply that number by the number of shares that I have, which is 25.52089252, plus a slightly favorable FX rate difference, you get an unrealized profit of £513.83. It's pretty simple maths. But how on earth, with Tesla's stock price being down 52.6% from all-time highs, am I still in a profit on this position? Well, that's thanks to understanding market cycles. And let me just say this isn't me predicting stock market cycles like I'm some kind of stock market investing genius, and instead it's more just the fact that I understand that they occur. Here is a theoretical market cycle where prices depict investor emotion. Market cycles can be a little bit of a self-fulfilling prophecy as and when market momentum changes, because investors are somewhat emotionally attached to the money that they have invested in the market. It's like a snowball effect. As soon as one investor hits sell, word travels faster and everybody else does the same thing.
You have to hold your nose and sell something because we're due for a pullback.
And look, when you've got multi-decade high inflation rates, rising interest rates, a war, a cost of living crisis, and a banking crisis, it's hardly a surprise that we've seen market prices come tumbling down in the past 12 months or so, whilst investor confidence is at all-time lows. But this is where the first part of the strategy comes into action. Warren Buffett once said, "Be greedy when others are fearful, but fearful when others are greedy." And right now, and over the past 12 months, it's been a great time to be greedy whilst everybody else is in panic mode. Because instead of buying Tesla stock at $400 per share, I've had the opportunity to execute on Tesla stock at $222 per share, $201 per share, and $172 per share. I've been buying the stock at a massive discount compared to all-time market highs, whilst also riding out potentially peak levels of fear and depression within the market. And if that's the case, the future profit potential from investing during this time will be absolutely huge.
Nice.
It's the strategy also known as cost averaging into the market, where you routinely invest despite market conditions. It's a set it and forget it investment strategy that has the ability to reap rewards over the long term. And here are some of the reasons why I think it's the best investment strategy for the average investor. Step number 2, the benefits of cost averaging. Number 1, you don't wait for the market. Look, you can sit around waiting for better days in the stock market, but every study that's ever been done suggests that if you wait and sit on the sidelines, then your future profit potential is capped. A study done by JP Morgan showed that your investment returns drop by nearly half if you miss just the best 10 days within the market, and get this, over the past 20 years. That is only a very small fraction of the total trading days available, that if you miss out on the best days within the market, then your future profits aren't going to be what they should be. But with cost averaging, you're completely committed to staying invested, and you're only ever going to be on the buy side of the equation unless you fit the following 3 pieces of criteria. Number 1, you're retiring and you want the money. 2, you're rebalancing your portfolio. Or number 3, your investment thesis is no longer valid. Other than those 3 pieces of criteria, I'll never sell, and therefore I'll be able to maximize my long-term potential returns. The second benefit is profit potential. Yes, you could argue that it takes balls and a very level head in order to invest during these terrible market conditions. And to be honest, if you feel any ounce of emotion about the fluctuations in value within your investment portfolio, the first things I'd say is turn off the news, automate your investments, and come back in 2025 and see where you're at. The truth is, many investors probably looked at stocks like Tesla, AMD, and Meta platforms and thought that they were trying to catch a falling knife. But these stocks, in my opinion, still have very good underlying fundamentals. As such, I took the opportunity to buy Tesla at $172 per share, AMD at $60 a share, and Meta at $92 per share. And based on current market prices, the profits on those 3 trades alone that I made currently look like this. So it's an investment strategy that allows you to capitalize more during bear markets when market prices are severely depressed. It's just how the law of percentages work. The third benefit, and probably my favorite, is that everybody can do it. All you do is you take a percentage of your income every single month and invest it into the market. It's quite literally the most accessible investment strategy that exists today. It doesn't require a lump sum investment of £50,000. It doesn't require a financial advisor, and in actual fact, you can invest for as little as £1 into the stock market on apps like Trading 2 on 2, thanks to something called fractional shares. So you don't even need to buy a full share of Tesla for $190, because you can literally buy just 0.01 of a share for less than a couple of quid. Now, of course, the more money that you can invest, the bigger the results that you'll be able to obtain. But all it really takes is for you to select a number of investments that you're comfortable with and then distribute that cash amongst those investments. And then you wait 5, 10, 15, 20 years or more, knowing that you've invested a ton of money into the market, into good quality investments, to see the profits within your account. It really is as simple as that. But how much profit can you make? Well, let's talk about step number 3, which is the projected profits. Now, let me just say this up front, massive disclaimer, this part of the video is far less factual, if you like, than I'd like it to be, because I'm going to model my investment portfolio and what it could potentially look like based on historical market data. And as the disclaimers always say, past performance isn't necessarily indicative of future results. And I do want to emphasize that point here before I share my model and analysis with you. So now we've cleared that up, now let me share with you guys how we're going to calculate my projected profits. We'll take the number of shares that I own in each stock and we'll multiply it by a low, medium, and high valuation. Here's the criteria. For a low valuation, we'll do the current share price plus 5%. For medium valuations, we'll do halfway between the current share price and the all-time high of that share price. And for the high valuation, we'll do the stock price's previous all-time high. This will give us what I believe is a fair analysis based on the stock prices that we've seen historically, without getting carried away. So here's how that looks in practice for my individual investments. So first up, that is my current portfolio valuation, which isn't massively dissimilar to what they were in my previous portfolio update. Then we've got the low valuation. Now, the little asterisk that I've put in is a slight adjustment to our criteria, because the S&P 500 ETF that I invest into, we've only applied a 2% adjustment rather than a 5% adjustment, because it's a less volatile investment. Then we've got medium valuations, where we're really starting to see a jump in the numbers at the midpoint. But if the stock market and all of these individual investments return to their previous all-time highs, well, then we're starting to see some really big numbers. And let me just say this, guys, those numbers that I've calculated are based on me never investing another penny into the stock market based on that model we've created. No additional principal, just pure growth in my capital gains. You can kind of see by comparing the high valuation where stock prices were all-time highs versus my current market value, just how much market prices have changed and are currently depressed right now. With the likes of Tesla, AMD, Amazon, and Meta being the ones that have huge upside to claw back from the recent sell-off. So that's at an individual stock level, but what about at a total portfolio value level? So here is the current value at 38.9k. The low value pushes us up to 40.9k, which is about a £2,000 gain. The medium value pushes us up to £54,000, which is just over a £15,000 gain. And the high valuation pushes us to £63,900, which is a gain of £25,000. And that's all completely unrealized profit potential. So hopefully what that demonstrates is the real power of cost averaging into the market during depressed market conditions and continuing to increase your holdings despite the fact that you might not see any upside momentum in the moment, or even perhaps for the next 12 to 18 months into the future. Because in the future, and perhaps in the future, we might mean 2, 3, or 4 years down the line where stock market prices go on to recover, which I'm confident that they inevitably will do at some point down the line, well, then we're looking at huge potential for upside. But let me just say this, that won't be mission complete for this investment portfolio. Because this portfolio, I really do want to still look to compound over the next 20 or 25 years. And that's to truly let the power of compounding take place. At which point, instead of looking at a portfolio value of about £60,000, instead what we'll hopefully be looking at is a portfolio value of £1.5 million instead.
Tell them to bring me my money.
And if you want to learn a little bit more about how you can achieve that, well, I'll leave a link to my Investing for Beginners program down in the description below. So hopefully you guys found that piece of analysis interesting. If you did, be sure to subscribe to the channel. With that being said, I'll see you over in the next one.